So, my dear CA inter students, so this is CA Thofik Tufel, and I am the FM faculty. So, in this video, particularly, I will be doing one problem, and that problem is based on investment decision. So, that problem is from RTP November 2018. So, from RTP November 2018, we'll be doing the problem. I'll be doing a series of questions, and those questions will be very interesting. It will be having some tricky adjustment. It will make you think, and it will give you, an examination perspective of how problems are solved. So, what are the advantages? One will be you will know how to solve the problem. Second, you will know how to present the answers. Third, you will get a right approach to get into the right direction of, going into the correct answer. So I'll share my screen. Okay. So we are doing this problem, which is from RTP November 2018. And question number 5. Question number 5, capital budgeting. So I always say reading the question is more important than solving the question. Okay. So let us read the question first. So this question is capital budgeting, and in capital budgeting, this is based on the replacement decision. We already know in FM we take decisions. So this is about replacement decision. Let us read the question first. Shiv Limited is thinking of replacing its existing machine by a new machine, which would cost 60 lakh rupees. So they want to replace their existing machine to a new machine, which means they want to purchase their own machinery, purchase the new machinery. So this 60 lakh is an initial cash outlay. We already know how to solve the problem. We have three approaches. We have three steps. First one is initial cash outlay. Like, what is the cash outlay that we are having in the initial year, which means year zero. And then we have annual cash flows. So what are the annual cash inflows and outflows with all the adjustments? The third one will be the terminal cash flow. So at the end of the project, when the project is ending, what is our cash flow? It can be scrap. Okay, it can be any tax benefit out of it. So this is the initial cash flow. This is the initial cash flow. So we'll read the question and make note all the numbers. The company's current production is 80,000. So currently the company is producing 80,000 units, and it's expected to increase to 1 lakh units. So from 80,000, if they're purchasing the new machinery, the units will be increased from 80,000 units to 1 lakh units. If the new machine is bought, the selling price of the product would remain unchanged at rupees 200 rupees per unit. So the selling price will be 200 rupees per unit. Okay. The following is the cost of producing 1 unit of product using both the existing and new machine. So now they are given that product costing. So 200 is the sales price, and all these are the cost. All these are the cost for existing machinery and the new machine. Okay, unit cost. So material per unit 75 rupees, wages 51.2537, supervision, we have repairs and maintenance, we have power and fuel, we have depreciation, and then we have allocated corporate overheads. Now you all know that in capital budgeting, we only have to take cash flows. And that too relevant cash flows. So material, it is an actual cash outflow. Wages and salaries, yes. Supervision, yes. Repairs and maintenance, yes. Power and fuel, yes. So depreciation is a non-cash expenditure. So depreciation is a non-cash expenditure that we should not consider. But if depreciation is included with tax impact, then tax impact on depreciation should be. So if depreciation is given, and in the question no taxes are given, just ignore depreciation. But if taxes are given, then you reduce depreciation, reduce taxes, and then add back depreciation. So the tax impact is getting, accumulated in that calculation. So allocated corporate overheads. I already said you, general overheads and allocated corporate overheads are irrelevant cash flow, because even if you're purchasing the new machinery or if you're not purchasing the new machinery, this overhead will be included. This is just allocated overheads. So allocated overheads are irrelevant cash flows that we should not consider. What is the reason? Why are we not considering it? Because maybe I'm having one head office, which is the cost of the head office is 1 lakh rupees, and I am just allocating it to 5 different branches, 20, 20, 20, 20, 20. So now if I'm purchasing one machinery in one of the branches, so that portion of the overheads will be allocated to that machinery also. But even if you're purchasing or you're not purchasing, that overheads will be incurred. So this becomes irrelevant cash flows because this is not relevant for a decision making. Relevant cash flows means cash flows that affects the decision. Irrelevant cash flows means cash flows that does not affect the decision. Okay, so this I will not consider irrelevant cash flows, and depreciation is a non-cash expenditure. Till now, the question is clear. Okay. The existing machine has an accounting book value of 1 lakh rupees. So the book value of the existing machinery is 1 lakh rupees, and it has been fully depreciated for tax purpose. So for income tax purposes, it has been fully depreciated, which means for income tax purpose, the book value is zero. For income tax purpose, the book value is zero. Okay. But the accounting book value is 1 lakh rupees. In our books of accounts, the value shows at 1 lakh rupees, but as per income tax, the value shows is 0 rupees. Now we are calculating tax as per income tax, so we have to take the income tax book value. This is one point that we will. Next, it is estimated that machine will be useful for 5 years. Okay. The supplier of the new machine has offered to accept the old machine for 2,50,000 rupees. Now I am having the old machinery. What the supplier is telling, I will give you the new machinery, and old machinery you can give it back to me, and I can give you 2,50,000 rupees for that new machine. Clear? So old machinery, you give that old machinery, I will give you 2,50,000, and then I will give you the new machinery also for that cost of 60 lakh. So my net cost is 60 lakh minus 2,50,000. This is what you have to understand from this. Okay. However, the market price of the old machine today is 1,50,000. Okay. And it's expected to be 35,000 after 5 years. So I'm having one existing machinery. I want to replace that existing machinery. The market value of that existing machinery today is 1,50,000 rupees. Now, for that market value of 1,50,000 rupees, how much is the amount that I'm receiving? 2,50,000 rupees. So, what is beneficial for me? Definitely, that 2,50,000 is the beneficial for me. So, I'm not having any, I'm not having any incremental. I'm not having any opportunity lost here. I am not having any opportunity cost here. Suppose here the market value is 5 lakh rupees. Okay, suppose if the market value is 5 lakh rupees, and if I want to purchase that new machinery and he is giving me only 2,50,000 rupees, so here I am having an opportunity cost of 2,50,000 rupees. Because had I sold that machinery in market, I would have received one 2,50,000 rupees, which is a cost to me. But here he is itself giving me 2,50,000 rupees. So I have to ignore all this opportunity cost. Okay. So I have to consider this 2,50,000 rupees as an initial cash out. Okay. In initial cash. In initial cash. This 1,50,000 I have to ignore. But one point is to be known. If this is more, if the market value is more, and the supplier is giving me only less 2,50,000, and if this is 5 lakh rupees, then that 2,50,000 becomes an opportunity cost to me. Because had I sold in the market, I would have received 5 lakh rupees. But because I'm purchasing the new machinery and then I have to exchange, he is giving me only 2,50,000 rupees. So that 2,50,000 rupees is my opportunity lost. Okay. But here nothing is to be considered because the market price is less. But scrap value after 5 years is 35,000. If I have the machine, after 5 years, that value would be 35,000 rupees. But now I'm selling that machinery. So this becomes my opportunity cost. Okay, this becomes my opportunity cost because I'm not getting anything, right? So this becomes my opportunity cost. And this is a terminal value because after 5 years, okay, so this is my terminal value, terminal cash. This is my terminal cash. The new machine has a life of 5 years and a salvage value of 2,50,000 rupees at the end of its economic life. Assume corporate income tax at 40% and depreciation is charged on straight line basis for income tax purposes. So for income tax purposes, the depreciation is charged on straight line basis. Further, assume that book profit is treated as ordinary income for tax purposes. Now, what does this mean? Assume that book profit is treated as ordinary income for tax purpose, which means whenever we are taking any tax sheet, okay, whenever we are taking any tax sheet, we have to consider that book profit as ordinary income. The opportunity cost of capital is 15%. So opportunity cost of capital is nothing but the discounting rate. So what discounting rate we have to take? We have to take 15% discounting rate to calculate NP. Okay, to calculate NP. The question is clear. Estimate the NPV. Okay, estimate the NPV for replacement decision. Second one, calculate the IRR for replacement decision. And third one is just we have to take the decision. Should the company will go ahead or not? Question is clear. Now let us solve. Okay, let us solve one by one. It is very clear. Okay, so this is RTP November 2018. Question number 5. Question number 5. Question number 5. Always, always prepare adequate working notes. So the first working note number 1. Initial cash outlay. Okay, initial cash. Let us see. First is I have to purchase this. I have to purchase this machinery for 60 lakhs. So this 60 lakh become my outflow. This 60 lakh become my outflow. And then this existing machine I'm having, right? This existing machine, because I'm exchanging it, he's giving me 2,50,000 rupees for this existing machinery. So first would be purchase. Purchase price of new machinery. What is the purchase price of machinery? 60 lakh. Why I'm putting it as negative? Because it is an outflow. I have to purchase, I have to pay them. So it is an outflow. Second one, it would be exchange value. It would be exchange value of existing machinery. I'm exchanging the machinery and I'm receiving 2,50,000 for it. So how much I'm receiving? 2,50,000 rupees is the amount that I'm receiving. Okay, 2,50,000 is the amount that I'm receiving. Now, I already said you, whenever this book value, this word comes, which means that you have to calculate the capital gain taxes also. So if you see the book value as per depreciation, as per income tax is 0. As per income tax, the book value is 0. But for this 0 value, I'm getting 2,50,000 rupees. For this asset, I'm getting 2,50,000 rupees. So what is my gain? My gain is 2,50,000 rupees. So on this gain, I have to pay some taxes, correct? So I'm having a tax expense. I'm having a tax expense, which is an outflow. So tax expense of 2,50,000 rupees into 40%. This becomes my tax expense. See, this is a revision video. Okay, so I'm not able to explain everything, but if you have attended the classes, you already know that this is the concept that I've took. So now we have, okay, tax expense. Okay, tax expense on capital gain of existing machinery. Capital gain exists only if we are selling. So because we are making a replacement decision, I'm selling. So what is my profit? My profit is, what is the amount? Sale value minus the book value. What is my sale value? 2,50,000 rupees. What is my book value? My book value as per income tax is 0. Don't take 1 lakh accounting book value. Income taxes. Okay. So my book value is 0 into 40% is the tax that I have to pay. So 2,50,000 into 40% is 1 lakh. I'm putting it as outflow because I have to pay. It is a tax expense. Had it been a loss, then I would be having a tax benefit, which becomes an inflow. Okay. Do we have any other initial cash flow? Nothing. Nothing more is initial cash. This is what it is. Okay. This 1,50,000 I have to ignore. Okay. This 1,50,000 I have to ignore because this is relevant for me. Because this is relevant for me. 2,50,000 is relevant for me. This 1,50,000 is irrelevant. Had this 1,50,000 be 5 lakh, then this 2,50,000 becomes my cost, opportunity cost. Clear. So we are not having any other initial cash outlay. So my initial cash outlay is minus 60 plus 2,50,000 minus 1, which becomes 58,50,000. Initial cash flow is negative 58,50,000. Let us go to working note number 2. Calculation of annual cash flows. The calculation of annual cash flows. Now here the point is, here the twist is. Okay, here the twist is. Let us first find out. You already know this 200 rupees is the inflow. Then if I'm purchasing the new machinery, all these are my cost. All these are my cost. This depreciation I will not take. This depreciation I will not take, because I will take that income tax depreciation. It's already given straight line method. So I will not take this depreciation. I will not take this allocated corporate overheads. This two amount I will not take. All these amounts I will take. All these amounts I will take as outflow. This 200 I will take as inflow. Are you getting it? This 200 I will take as outflow, inflow, and these amount I will take it as outflow for new machinery. So this will be my contribution. Okay, sales minus all the variable cost. This will be my contribution. Okay, this will be my contribution. Then I will reduce depreciation, I will get profit before taxes. Okay, first I will have sales amount. Okay, then I will have all the variable cost amount. I will get the contribution. I will get the contribution. Then I have to reduce the depreciation. So after depreciation, I don't have anything called as interest here. So after depreciation, what I will do, this will become my profit before taxes. Then I have to reduce the taxes here. After reducing the taxes, I will get the PAT. And then this depreciation, I have to add back. To add back this depreciation, that will give me cash flow. That will give me cash flow. This is what is the approach. Okay, this is what is the approach. So what is my sales? Let us first calculate the contribution. Okay, let us first calculate the contribution. Let us first calculate the contribution. Okay, sales for existing machinery and for new machinery. You all would be thinking, sir, new machinery only we have to take. Why are we calculating contribution for existing machinery? Wait, I will answer. Okay, so sale for both it is 200 rupees. Okay, minus variable cost. Variable cost except depreciation. Why depreciation? Because it is a non-cash expenditure and I have to take that income tax depreciation, not this. And then next one is allocated general overheads. Okay, allocated general overheads. So this I have to minus. So first let us minus all this 75. Okay, let us minus all this. So what I'm getting, 75 plus 51.25 plus 20 plus 11.25 plus 15.5. So I'm getting 173. So I have to reduce 173 rupees is my variable cost. For new machinery, it is 63.75 plus 13.75. Okay, 63.75 plus 13.75. 63.75 plus 37.5 plus 25 plus 7.5 plus 14.25. I'm getting 148. Okay, 148. This is the income that I'm getting. So now this will become my contribution. So here my contribution is 27 rupees, and here my contribution is 200 minus 140. This will become 52 rupees. Okay, this will become 52 rupees. You all will be thinking, sir, this is my actual inflow, correct? Existing machinery is not my inflow. This is my actual inflow. So I have to take 52 into 1 lakh units. Okay, into 1 lakh units. So number of units. Okay, number of units. Here I'm having 80,000 units. So here I'm having 1 lakh units. So my total contribution in rupees will be, here it will be 52 lakhs. And here it is 80,000 into 27. This becomes 21 lakh 60,000. Now you all will be thinking, sir, since we are taking a new machinery, my inflow, this is my contribution and all these are cash. Okay, this is cash inflow and this is cash out. So my inflow is 52 lakh rupees. My inflow is 52 lakh rupees. I already said you, this is a capital budgeting. In capital budgeting problem, we have to take relevant cash flows. We have to take incremental cash flows. Okay. Now, if I want to take my incremental cash flows, what will I see? I have to see if I am purchasing a new machinery, I will get an inflow of 52 lakh rupees, okay, for 1 lakh units. But because I'm purchasing the new machinery, this existing machinery, I was getting this contribution of 21 lakh 60,000 rupees that I will not get now, correct? That I will not get. This 21 lakh 60,000 rupees, the inflow which I was getting from existing machinery, I will not get now because it is a mutually exclusive decision. I will not get now. So I have to see that what is my increase in revenue, what is my increase in cash flow. That is what I have to see, incremental cash flow. I have to see the incremental cash flow. This 52 lakh I'm getting, well and good. Okay, this 52 lakh I'm getting, but this 21 lakh 60,000 I will not get now. This 21 lakh 60,000 I will not get now. So I have to see what is my incremental cash flow. So what is my incremental contribution? Okay, I have to see what is my incremental contribution. It is nothing but 52 lakhs minus 21 lakh 60,000. Okay, 52 lakh minus 21 lakh 60,000. I am getting 30 lakh 40,000 rupees. So I have to take 30 lakh 40,000 rupees as my cash. Now you all will be having a doubt. What, sir? You're confusing us. You have to take actual cash flows. My actual cash flows is 52 lakh. My actual cash flows is 52 lakh. Then why are you doing this 21 lakh? You are reducing 21 lakh 60,000 from here. See, we have two approaches to the problem. One is calculate the total cash flows for existing machinery. Okay. And then you find out the NPV. Then calculate the total cash flows for a new machinery. Then find out one NPV. Then see which NPV is more, that you have to take the decision. That is how you have to take a decision, right? From existing machinery, what are the cash flows that I'm getting? Okay, initial, annual, and terminal. From new machinery, what are the cash flows that I'm getting? Initial, okay, all this. And then you calculate the NPV. And then after calculating the NPV, you have to see where the NPV is more. So instead of doing this two, this is called as total approach. Okay, this is called as total approach. We have one more approach, which is called as incremental approach. Anyhow, so what I will do, I will find out the net present value. This new machinery cash flow minus old machinery cash flow is my net cash flow. Is my net cash flow. If it is positive, I will accept. If it is negative, I will reject. That is how I have to take, correct? So that is the reason this is the incremental approach. So that is the reason I'm taking incremental contribution. This is where lot of students will make mistake. What lot of students will do? They will write the answer as 52 lakh and then they will calculate the net present value. But that is not the net present value. That is the present value of new machinery. You have to minus present value of old machinery also, right? So instead of calculating the present value of old machinery and then minusing, what you are doing actually from the cash flow itself, you are reducing it. Anyhow, you will get the same answer. Okay. So this becomes my incremental cash flow. This forms an important adjustment here. Okay. This forms an important adjustment here. Okay. Then from here, the question is simple. Then what you have to do, you have to reduce depreciation. Okay. So depreciation is one annual cash flow, correct? Depreciation is one annual cash flow. So terminal cash flow, then you have annual cash flows. Depreciation where it is given. Yeah, the new machinery is having a life of 5 years and salvage value of 2,50,000. So this 2,50,000 is also a terminal cash flow. Okay, this is also a terminal cash flow at the end of its economic life. So the new machinery is having, and if you see depreciation is charged on straight line basis for income tax purpose. I said we have to take income tax depreciation. So income tax line, it is straight line. So I have to take, it is 5 years and 2,50,000 is the scrap value and straight line method. So which means the cost of the machinery is 60 lakh minus 2,50,000 is the scrap value divided by 5 years is the economic life. This is how you have to calculate depreciation, right? So straight line method depreciation, I'm doing it annual, okay? So depreciation, so what is my depreciation outflow? It is 11 lakh 50,000. I have to add back this also. I'm not having any taxes at all. So this becomes my profit before tax. So what is my profit before tax now? 18 lakh 90,000 is my profit before tax. Now I have to reduce taxes. I have to reduce taxes. Taxes at the rate 40% of the taxes. So 18 lakh 90,000. What are my taxes? 7 lakh 56,000 are my taxes. Okay, 7 lakh 56,000 is my taxes. Now what I will get? I will get the PAT. What is my PAT? PAT is 11 lakh 34,000. So now what I have to do? I have to add back depreciation. This is a non-cash expenditure, so I'm adding back. So 11 lakh 50,000. What I'm getting? 22 lakh 84,000. So 22 lakh 84,000 is my Net annual cash flows is my net annual cash flow. So every year, net annual incremental cash flow is 22 lakh 84,000. Clear? Second part over. Now at the end of the project, what are the terminal cash flows? Working on the see, we don't have any other annual cash flows. If you read the question, it is just depreciation is given and nothing else. Annual adjustments are given. Okay, and all these values are given that we have already considered. This depreciation we are not considering because I'm considering that depreciation. Now here one special adjustment, what one can happen. Okay, what one more adjustment can happen is that say this is income tax depreciation. Okay, say this is income tax depreciation. Then we also have to see what is the increase in income tax. See, because I was having old machinery, I was having 0.25 as the depreciation. Because of new machinery, I am having 5 rupees as the depreciation. Okay, so my depreciation expense have increased. Because my expense is increasing, okay, because my expense is increasing, I'm getting tax benefit. So here I will get tax benefit of 5 minus 0.25. Okay, 5 minus 0.25, which is 4.75 into the tax rate. Suppose if these both are income tax depreciation, this is one more special adjustment possible. I'm just, trying to give more concept into the same problem. So here, this is accounting profit. That is the reason I'm ignoring. Suppose if this is itself this is the income tax profit and their income tax depreciation is given for the existing machinery, actually income tax depreciation is not given. Okay, because it is already depreciated. It is already depreciated and it is written down as zero. But for example, suppose I am having for existing machinery also I'm having the depreciation amount annually. For new machinery also I'm having the depreciation amount annually. Then I will be having tax benefit. If there is an increase in depreciation, I will be having tax benefit on the increased depreciation, and that I have to do. Okay. If I have that problem, I will share that with you also. Okay, but here this point is not there. I'm not trying to confuse you. Okay, I'm just giving you this point so that whenever you see the question, you have to keep it in the back of the mind. Otherwise, do whatever the question is telling. Okay, don't question the question. Okay. So net annual cash flows. Let us go. Working note number 3. Working note number 3 is okay. Terminal cash flows. Terminal cash flows. The first one, I would get the scrap inflow. Okay, I will get the inflow. I will get the first is the scrap value. First is the scrap value. What is the scrap value? At the end of the 5 years, the scrap value of new machinery. Okay, scrap value of new machinery. Scrap value of new machinery. What is my scrap value of new machinery? It is, bacha, it is 2,50,000 rupees. It is 2,50,000 rupees. I will put as inflow. Now, since it is incremental calculation, I have to reduce the scrap value of old machinery. I will tell you why. Had I used the old machinery, I would have got the scrap value of old machinery also. What is the scrap value of old machinery? 35,000 rupees. Because after 5 years, it is 35,000 rupees. Now, because I'm purchasing the new machinery, I am not getting that 35,000 rupees. So, not getting a benefit now. Like foregoing benefit is a cost. Okay, foregoing benefit is an opportunity cost. Okay, so this will be my opportunity cost of scrap for existing machinery minus 35,000. Okay, this is one way of understanding. I'll give you another way of understanding. So I will give you all the possible logical explanations for you so that you don't get confused. Okay. So how we have to think like that is that I already said you where we have two approaches. One approach is total approach. Find out the cash flows. Okay, find out the initial cash flow, annual cash flow, and terminal cash flow for old machinery, existing machinery, and find out the initial cash flow, annual cash flow, and terminal cash flow for new machinery. Okay, you will get NPV. Say the NPV of this existing machinery is 50,000 and NPV of new machinery is 1 lakh rupees. Okay, then which machine, then which decision you will choose? You will choose because the NPV of new machinery is higher, so you will choose the new machinery over. Okay, so you have to see the net present value. If you want to calculate the net present value, what you have to do? This 1 lakh minus 50,000. Then you will get the net present value. You have two present values. If you want to find out the net present value, because this is an outflow, okay. If you do the net present value, you will get 50,000 rupees. If net present value is positive, accept. If net present value is negative, reject. Okay. So what you have to do, you have to reduce that. Okay, you have to reduce all the cash flows of the old machinery. So instead of reducing the net present value, you're reducing the cash flows. So here, okay, if you see here, just one minute. If you see here, why I'm reducing the contribution here? Because I'm reducing the cash flows. This is the cash flows of old machinery I'm reducing here. Why I'm reducing the scrap value 35,000 here? Because this is the cash flow that I've been getting from the old machinery that I have to reduce here. This becomes my opportunity cost, or I have to reduce it there. I have to reduce it there. Only then I will get the net present value. So the cash flows of old machinery I have to reduce from the new machinery. This becomes my cost. Okay, this becomes my cost because this is the benefit that I'm foregoing. So even if you have any doubt, you can write it in the comment section. I will try to answer that. I've given you all the logical explanations, but yeah, every student thinks differently, and I respect that thinking. So you can ask your doubts, however stupid it is, I'll be there to answer. So this is the terminal cash flow. This is the terminal cash flow. What is the terminal cash flow? 2,50,000 minus 35,000. So 2,50,000 minus 35,000. What is the amount that you're getting? 2,15,000 is the amount that I'm getting. Okay, now the calculation of NP, calculation of net present value, calculation of net present. Okay, year particulars. Okay, year particulars. Present value factor. What is the percentage? 15%. Okay. Cash flow. So year particulars, cash flows, present value factor, and then discounted cash flows. Present value factor or present value annuity factor. Because it is annuity cash flows. I'm writing annuity cash flows here. Instead of writing 0, 1, 2, 3, 4, 5, 5, I'm writing 1, 2, 5. Okay. So 0th here, I'm having initial cash flow. Okay, initial cash flow. Working note number 1. Working note number 1. What is my initial cash flow? I will just select this. Okay. Now, what is my initial cash flow here? Initial cash flow is 58,50,000. It's from working with 58,50,000 rupees. The discounted cash flow is 58,50,000 rupees. From 1 to how many years? 1 to 5 years, I'm getting annual cash flows. I'm getting annual cash flows. What is my annual cash flows? 22,84,000. It is an inflow. Okay, 22,84,000. Now, because it is annuity, I have to put as present value annuity factor. So let us see what is the present value annuity factor for 15. Annuity means I have to add all this percent. I have to add all this percent. So 0.8696. Okay, 0.8696 plus 0.7561 plus 0.6575 plus 0.571 plus 0.497. What is the amount that I'm getting? 3.353. Okay, I'm nothing. What I'm doing, I'm just adding. Okay, I'm just adding these four values. Or what you can do, year 1, 2, 3, 4, 5, put all the same values, and then you have to multiply each one, and then you have to add it. Okay, any approach, whatever approach you're following, this is the approach that I teach in the class. If it is annuity cash flow, just directly write present value annuity factors. So 3.3522. Okay, 3.3522 into 22 lakh 84,000. You will get the discounted cash flow. So what is my discounted cash flow? 7 crore 65 lakhs. Sorry, it is 76 lakhs. It is 76 lakhs 56,425. It is 76 lakh 56,425. Clear. Now again, fifth year, your terminal cash flow. This is an inflow out. This is an inflow. 2,15,000 is an inflow. 2,15,000 because this is a fifth year. I will take the fifth year present value factor. 0.4972. Okay, 0.497. Okay, 0.497 into 2,15,000. What is the amount that you're getting? 1,06,898. So this will be your net present value. So this 76,56,5 minus 50,000. You're getting 19 lakhs 13,320. Let me check the answer. Fifth one. Question number 5. Okay, very good. See. So they are giving the answers in thousands. Okay, they are giving the answer in thousand. If you see this, okay, if you see this market value of old machinery, the old machinery could be sold for 1,50,000 in the market. Since the exchange value is more than the market value, this option is not attractive. So this opportunity lost, whether the old machine is retailed or replaced, the opportunity will be lost. So thus on incremental basis, it has no impact. Okay. So the depreciation base original cost 60 lakh, then net cash flows. Okay. Net cash flows. If you see the calculations, they are doing it, then tax shield on depreciation. Little bit confusing, and then the logical way, you can also do this way. But since the answer is 19 lakh 13,000, okay, 19 lakh 13,000. So I'm getting the 19 lakh 13,323 as net present. So this is your NPV. Now the next is very simple. Okay, actually NPV is positive. You have to accept. Now let us calculate the IRR cost. IRR is very simple. Already IRR. Many people think it is tough, but yeah, once you have the cash flows, it becomes very simple. Now 15% it is positive. Okay, 15% it is positive. So which means you have to increase your discounting rate to get the negative cash flows. To get the negative cash flows. So what you do, you first do 25 lakh. Okay, you first do 25 percentage and check whether you are getting positive or negative. Okay, check whether you are getting positive or negative. If you are getting negative here, do 20 percentage. It will be definitely positive. Then 20, 25 you can interpolate. Okay. So let me do 25 percentage first, and then okay, let me do 25 percentage. See, I can do 20 percentage first. But if it is positive, again, I will do for 25 percentage. Again, it will be positive. I will do for 30 percentage, which means this 20 percentage calculation will be waste of time for me. So this is one trick. This is one trick for examination. This is one trick for examination that you have to, whenever options are given for the rate, what you have to do, you have to take the middle tax rate. You have to take the middle tax rate so that you can save the times. So let me calculate the NPV. I mean, let me calculate the discounted cash flow for 25% first. And then if it is positive, I will take 30 percentage. And if it is negative, I will take 20 percentage. Are you getting the logic? Okay. So now the second part of the calculation, it is calculation of IRR. Calculation of IRR. Okay. So here, cash flow, present value factor at the rate 25 percentage, discounted cash flow, and then present value factor. Let me see what I have to take. So 0, 1 to 5, and 50. Okay, what is 0th year cash flow? 58 lakh 50,000. Okay, 58 lakh 50,000. You do it on your own. Okay, this is very simple. So 22 lakh 84,000, 22 lakh 84,000. What is the fifth one? 2 lakh 15,000. 2 lakh 15,000. So here this is 158 lakh 50,000. Now 1 to 5 years. Let me take for 25% in 1 to 5 years. So 0.8 plus 0.64 plus 0.512 plus 0.4096 plus 0.3277. What is the amount that I'm getting? Oops, I did one mistake. 0.8 plus 0.64 plus 0.512 plus 0.4096 plus 0.3277. I'm getting 2.6893. 2.6893 into 22 lakh 84,000. So 61 lakhs 42,361. For the fifth year, it is 0.3277. 0.3277. So 2 lakh 15,000. I'm getting 70,456. Okay. Now let me see what is the TC. 61 lakh 42,361. 61 42,361. 7456 minus 58. I'm getting positive. I'm getting positive 3 lakh 60 to 8%. 3 lakh 60 to 8%. Now, since it is positive, now I have to increase it to 30%. Now, just imagine had I took 20%, again that would be positive. Then again I have to calculate for 25%, again that would be positive. Again I have to calculate for 30%, then that may be negative, but that one calculation would be, an extra step. That would be an extra step that would take an extra time. That will take extra effort. So in examination, you have to use this smart techniques. You have to use this smart techniques. So for 25%, okay. So they took for 20% and 30%. But let us take for 25% because that is also positive, right? So then we have to take for 30%. Okay, let me go ahead with the calculation and check the answer afterwards. Okay, I hope we are not doing any calculation mistakes here. I'll just recheck the calculation once again. 1 to 5 is 25%. 0.8 plus 0.64 plus 0.512 plus 0.4096 plus 0.3277. I'm getting 2.6893. Getting 2.689 into 22 lakh 84,000. I'm getting 61 lakh 42,360. Great. Okay, I don't think so. That is some problem. It is okay. Now let us go for 30%. So present value factor at the rate 30%. So let me just calculate this annuity factor point. Or you can actually in the examiner what you can do, you can actually do present value annuity factor and you can calculate for all. So that while doing it, so this is one more trick. While doing it, you don't have to, you just have to take the number from here. Because here I have to do again and again, right? So now for 30%, 0.7692 plus 0.5917. Because while doing the problem, you will be in that pressure. So in that pressure, this addition, this calculation, you can make some mistakes. So this is one more trick that we can use. Okay, 0.4552 plus 0.3501 plus 0.2693. What is the amount that you're getting? 2.4355 or 2.4355. So this is 2.4355. This will be 1 and this will be 0.2693. So again, discounted cash flow. I think this will also be positive. Just assume. So 0.52 lakh 84,000. 5 lakh 56,000. Sorry, 55 lakh 62,682. So 0.2683 into 2 lakh 15,000. What is the amount that I'm getting? 5 lakh. Okay, sorry, 57,685. 57,685 plus 55,62,682 minus 58 lakh 50,000. 50,000. Very good. I'm getting negative. Negative 2 lakh 29,633. Okay, fine. So now I'm getting proper. Okay. For 25%, okay, for 25%, my present value is 3 lakh 62,817. For 30%, my present value is 2 lakh 29,633. Okay. I want my NPV as 0. Wherever the NPV is 0, that is my IR. Okay, that is my IR. I will do both the methods. Conceptual method also, I will do formula method also. So for increasing 5% in discount rate, how much is my NPV has reduced? My NPV has reduced from 3,62,000 to 8 lakh, 3,62,817 to 2,29,000. So it has reduced. Okay, it has reduced double. So 3,62,817 plus 229,633. So it has reduced to 5,92,450. What is this amount? This is nothing but 362,817 minus of minus 2,29,633. I just have to see how much is my reduce. Okay, how much is reduced. So now what percentage increase will reduce my NPV to, I want my NPV to 0. So when my NPV will become 0, if it is reduced to 3,62,817, if it is reduced to 3,62,817. Now, so if my increase in 5% is decreasing my NPV to 5,92,450, so what percentage increase will decrease my NPV to 3,62,817? It's a simple cross multiplication. So what I will do, so this increase in percentage is equal to 3,62,817 into 5 divided by 5,92,450. Okay. So 362,817 into 5 divided by 592,450. What is the increase in percentage? My increase in percentage is 3.06. Okay, 3.06. So therefore, IRR is equal to, from 25 I have to increase. Okay, so from 25 percentage plus 3.06 percentage. Therefore, IRR is 28.06 percentage. Let me see, 28.06 percentage. This should be the correct. Yeah, 28.23, because they are taking 20 and 30 percentage. Okay. So it is close. Okay, it is close. We have some rounding ups because we are taking two different ways. So this answer is also correct. If it is around 28%, or you just write or 28%. Okay, approximately our IRR is 28%. You write this in the exam so that you know the how knows who the examiner is. If the examiner is not a proper financial management person, what he will think, oh, 2 3 and 0.06, okay, wrong, half mark he will cancel. You don't do like that. Just put approximation 28%, and you can write, okay, the difference can be because of rounding off, okay, because of interpolation. You can write by interpolation. Okay, by interpolation, approx. Okay, we just write like this. This is just to be at a safer side. Now the second is we have a formula method. What is the formula for IRR? Lower rate plus, okay, lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. What is the lower rate? Lower rate is 25%. Okay, 25% is the lower rate. Correct. 25% is the lower rate. What is the NPV at lower rate? NPV at lower rate is 3,62,817. Okay, 3,62,817. So what is the NPV at lower rate and higher rate? 229,633. So minus of minus. So minus of minus 2 lakh, 2,29,633, 29,633, and you have to do 3,62,817. So 3,62 minus NPV at higher rate, but NPV as higher rate is negative, so this becomes plus. Okay, what is my higher rate? My higher rate is 25. What is my lower rate? My lower rate is sorry, higher rate is 30. What is my lower rate? My lower rate is 25. Okay, so 25 plus what I have to do, 362,817 into 5. Okay, 362,817 into 5 divided by this. What is this divide? What is this plus this? This plus this is nothing but 592,450. Okay, 592,450. So 362,817 divided by 592,450 into 30 minus 25 into 5. What is the amount that I will get? The amount that I will get is 3.06. 3.06. 362,817 into 5 divided by 592,450. The amount that I will get is 3.06. Okay, 3.06. Therefore, IRR is equal to 28.06% or 28% approx. Okay, approx. This is how we have to present the answer. Now the third part of the question. Okay, second part of the question is over. Let us see. Okay, don't stop here. Don't stop here. Always see the question again. Or 2 marks gone. Okay, for decision itself 2 marks. See, this you have done. This you have done. The NPV, you know. This also you have done. IRR, you know. Should the company go ahead with the replacement decision? Analyze. So you have to write the answer. Yes, the company can go ahead with replacement. Okay, replacement of existing machinery to new machinery. Why? Because we have a positive NPV. Because we have a positive NPV of what is the NPV? Just write that amount. So what is the NPV? We have NPV 19, 13, 323. 19, 13, 323. Also, just write that IRR point of view also. This is done. Also because IRR is 28 percentage. Okay, IRR is 28 percentage, and the cost of capital of the company. Okay, and the cost of capital of the company is how much? 15 percentage. Therefore, we have therefore it is advisable. Okay, because we have to advise. Therefore, don't tell go for replacement decision. Egoistic answer, no. Therefore, it is advisable. Diplomatic answers. Okay, therefore it is advisable for replacement. Okay, therefore it is advisable for replacement. This is how you have to do the problem. Okay. So this problem is completed. I hope you have learned some new adjustments. Okay, and this is a different kind of problem where people can make mistakes. Here we had the tax adjustment, that scrap value, book value adjustment, and this is an incremental approach problem. You have to think like that. You have to think like that. How do you have to think like that? If you have this replacement decision problem, this is how you have to solve the problem. Okay, so this is RTP November 2018, question number 5. Okay, so see you until the next week. Thank you.